Very good afternoon to all of you. May I just test the mic and the audio and ask any one of the participants to respond if everybody is able to hear me as well as see me? Please type in yes in the chat box if you are able to see me as well as hear me. Thank you very much for responding, Prashasti. Good afternoon, everyone. This is Shalini Gera, Senior Partner at Ingenitis and a Certified Financial Planner. On behalf of Ingenitis, I welcome you all to VIDYAA. VIDYAA is a series of financial awareness programs that we have designed for the mass audience. And this is the first time, as a first initiative, we are launching it to the open market, to the open audience. And the aim of this series is to give a structured approach to financial planning. So, whether you are a college student earning a pocket money, or you are about to get retired, or you're a young professional, or even self employed, then this webinar is for you in order to understand what a structured approach to financial planning should look like. So, let me give you a disclaimer for the session. I'd request all of you to keep your cameras as well as mics off in case anybody has them on for the session. And we'll keep the first 40 to 50 odd minutes for the presentation, and the last 5 to 10 minutes will be for the question and answer session. I'll request all of you to make this as interactive as possible. If I continue to talk for the next 45 minutes, it's going to become highly boring. So let's make this as interactive as possible. I'll be asking you questions, and you answer them in the chat box, and during the last 10 minutes of the session, you can answer any questions related to your financial planning, and I'll take the answers. So without much ado, let's get started. I hope everybody is able to see the presentation screen. Prashasti or any of the respondents, if you're able to see the presentation screen, please type in yes in the chat box and we'll get started. I hope all of you are were able to see the presentation screens. Thank you, Prashasti, for answering. All right, let's get started. So I'll be talking about Ingenitis for the first 5 minutes. We'll discuss a structured approach to financial planning, what that should look like for you. And the last 5 to 10 minutes we'll be keeping for all questions and answers. So Ingenitis was incorporated in the year 2012. We were incorporated as a financial planning organization. It's been a good 11 years. And over the years, the verticals that we have managed have been investment advisory, where we discuss all investment products and solutions, including mutual funds, portfolio management services, alternate investment funds, and any other asset class that you would like to seek an advice on. We discuss protection advisory, where the aim is not just to give you a protection policy or an insurance policy. The aim is to tell you what kind of financial protection does your family need. God forbid if the income of the breadwinner should stop suddenly. In the vertical of lending advisory, we talk about what sort of loans are running in the family, if they can be reduced, if the running rate of interest can be reduced using a balance transfer, and the remaining surplus can be utilized to build a corpus for you. In the tax planning vertical, we talk about various sections of the Income Tax Act in order to reduce the amount of taxes that you are paying to the government. And fifth and finally, we talk about estate planning. This will be more applicable to the retirees watching this webinar. All those people who are about to retire or who have managed to accumulate various assets during their lifetime. Why do we earn? We earn so that we can have a good life for ourselves, and we also earn so that we can ensure that all of those assets that we have accumulated are able to transfer to our loved ones, to our children, to our beneficiaries. So using estate planning, we are able to design a will for you, we are able to register the will for you, and we are able to ensure that our children, our loved ones don't have any problems accessing our assets. Let me also share the various pain points that we have identified in the market, which was the starting point of this organization. So the pain point that we realized in the market was mis-selling. And for this, let me share a story with you from the starting of my career. So in 2011, when I started my career, I had to do my tax planning. So the young audience who's watching this program, whenever you start working, whenever you start your career, so you every year you will have to do your tax planning. For your tax planning, you will have to submit your investment proofs to your organization in order to tell the organization, look, these are the investments that I'm doing, so please do not deduct taxes on all of these instruments. So I had to do the same in my career, but I was very, very late for doing it. So the deadline for submission of my investment proofs to my organization was 31st of January 2012. And on 30th of January, I walked into a bank's branch looking for tax planning product. So it was a fine, cold January morning, and I wanted a tax saver fixed deposit, which was giving me a 9.5% return at that time. As I walked into the bank's branch, now it was a cold January morning, and I was met by a well dressed privileged banker wearing a suit, a tie. And he asked me that, why do you want to go for a tax saver product? Why do you want to go for a tax saver fixed deposit rather? Instead, you should be opting for a guaranteed investment plan. Now, please hear this question very, very carefully, because there is going to be a question at the end of it. So I want all of you to hear this story carefully and put in your answers in the chat box when I ask the question. So this privileged banker offered me a guaranteed investment product instead of a fixed deposit. And he told me that you should be investing in this guaranteed investment product. Every year, you have to invest X amount of rupees. This amount will be invested for 7 years. And after 15 years from now, you will get double the amount that you have invested. I hope you've heard this carefully. So, the pitch of the product was that you are going to get 100% guaranteed returns. I'll repeat the stats for all of you. I wanted a tax saver fixed deposit, which was giving me a 9.5% return. Instead, I was being offered a guaranteed investment product, which was offering me the chance to get 100% guaranteed returns after 15 years. Now, when I analyzed both the products, the fixed deposit versus the guaranteed investment plan, I realized that in spite of the fact that the guaranteed investment plan was offering me a 100% guaranteed return, I was better off with the fixed deposit. My question to all of you is why? Why do you think I was better off with the fixed deposit and not with the guaranteed investment plan? I look forward to all of your answers in the chat box. So there are two reasons as to why the guaranteed investment plan was not better. Rather, the fixed deposit for giving me 9.5% return was better. My question to all of you is why? We'll wait for the next 1 minute for all answers to come in. Any guesses? You don't have to do any calculations, but do give an educated guess. Why do you think the guaranteed investment plan was not worth it, and the tax saver fixed deposit giving me a 9.5% return was better? The answer is hidden in the question itself. Come on, audience. We decided to make this as interactive as possible. I'm not getting any answers from you. Okay, so Piyush says FD being a conservative instrument. So, okay, Piyush, you think FD is a conservative instrument and that's why it was better. Prashasti says inflation. Let me also show the answers which are coming in on the screen. Uh, Asmita says effective return for the guaranteed return is not even 6%. So Asmita, you're very, very close to the answer. You're right. The one part of the answer is that when I did the calculations, the back end calculations of the annualized return which the fixed deposit was giving me was 9.5%, but the annualized return which was the guaranteed investment plan was giving me was only 6 to 7%, not more than that. So this is one part of the answer. And all right, so Sifty has said that there might be a difference in the annualized returns of both the instruments. Absolutely right, Sifty. And there's another second answer. And the answer lies in the fact that as financial planners, we recommend that you should have as much as liquidity as possible. So always ensure that you have financial products which are not locked in. It is not necessary for you to have lock-in products in order to generate good returns. That's an absolute myth. So in that tax saver fixed deposit, I had to invest for 5 years, but that guaranteed investment plan was giving me my money back after 15 years. Yes, so Asmita rightly identified that the problem was with the lock-in product. So, due to these two problems, the tax saver fixed deposit was a much better product. So, going back to our presentation, this was the pain point in the market, that nobody asked me what my financial goals were. Nobody asked me what my risk appetite was. Nobody asked me what my return expectations were. I was a 23-year-old kid who could have decided to take a lot of risk with my investments with high return expectations, but nobody bothered to ask me about all of that. Instead, I was pitched products which made sense to the bank. I was pitched products which were giving high revenue, high commission to the bankers. So we wanted to establish this organization to do away with this pain point. We established an organization which identified a structured approach to financial planning. I'll talk about the structured approach in the next slide. We only work upon need based products. So we ask the individual, we ask clients, what are your financial needs and financial goals? What is your risk appetite? What are your return expectations? And then we curate a financial plan around those key questions. There is also a very, very high focus upon research based advisory. So there's thorough qualitative as well as quantitative research, which are put on various financial products and solutions in the market. The best out of the lot are selected, and then only a financial plan is constructed for you. So this is what your guide to investment planning should look like. Now, whether you're working with the bank, you're working in the sense of investing, whether you're investing with the bank, you're investing with a financial advisor, you're working with Ingenitus, you're doing it solo on your own, make sure you diligently follow this guide to investment planning. And this should look like, the first part of this process is identify your financial goals. What are you earning for? What are you investing for? So these should be categorized in three parts. The first part should be short term goals. Short term goals are less than 1 year old in tenure. Then there are medium term goals, which are 1 to 3 years in horizon. And then there are finally long term goals, which are more than 5 years in horizon. Each and every goal will have a different treatment to it. The second part of the process is to identify your risk profile. Are you a conservative investor? Conservative investor means I'm happy with the 6 to 7% return that I'm getting in a fixed deposit. I don't want any sort of a risk going about. Are you a moderate investor? Moderate investor means I am willing to take a certain degree of risk, provided I know that that risk component is going to be rewarded with equivalent returns. Or are you an aggressive investor? By aggressive investor, I mean that you should be willing to take a high degree of risk, knowing that you will also be rewarded with high degree of returns. Remember, the higher the risk that you are willing to take, the higher the returns that your investments will reward you with. The third and the final part of your financial investment planning should include asset allocation. Now, this is a very interesting component, but it is also a very important component. Your financial portfolio should look like an Indian platter. Uh, Think about what an Indian plate or Indian platter looks like. It has chapati, it has rice, it has salad, it has curd, it has curries, and for good measure, it also has a sweet or dessert in it. So that's exactly what your financial portfolio should also look like. There should be various measures of equity. Equity will ensure that you get capital appreciation. There should be debt. Debt will ensure that you have capital protection. And then finally, you should be having global equity as a component as well. Global equity is going to give you exposure to various good quality international stocks. And over the past decades, we've seen that US markets, global markets have been able to beat the Indian markets by a margin of about 3% annualized. This gets us to our first interactive round of the session, which is goal planning. And for this, I am going to ask you to open your web browsers or open your phone browsers, put in the URL www.menti.com, which is displayed on the screen. The spelling is menti.com. You will be prompted by a code. Put in the code 89626373, and you will be prompted with the same question: what are your prominent financial goals? I want you to think, and then I want you to answer what are your most prominent financial goals. Why do you want to invest? Why do you want to earn? What are you earning for? You can put in as many answers as you like, and your answers are going to be displayed live on the screen. So let's figure out what are the various financial goals for the audience. I hope all of you are able to see my screen. There is also a QR code which is displayed. If you are able to see it properly, you can scan the QR code. We are starting to get answers. Great. For those of you who have not been able to enter, I'll repeat the instructions. Go to your web browsers or phone browsers, enter the URL www.menti.com, MENTI.com. Use the code word 89626373. It's time to get in answers. Those of you who are able to use the QR code, you can scan the QR code displayed on the screen. We'll wait for the next 1 minute for all the answers to come in. Very, very different answers coming in. So I'm actually quite surprised to know that, in spite of the fact that we have a very, very young audience, all of them are very critically interested in planning for their retirement. Good to know about that. Please do note that retirement is that one goal for which no bank will give you a loan. So that should be your first most goal that you should be planning for. Yes, retirement planning has indeed become the most important financial goal. Then we have a vacation planning, good. Where there's hard work, there should also be partying. And then there is the house planning, which has also become the third most important goal. So let's find out what most people tend to plan for. And are you prepared to plan for all of these goals financially or not? So this is what the industry's most common financial goals are: education planning for their kids, retirement planning for themselves, emergency planning. So now this is a critical goal that needs to be a part of all of your financial planning, no matter what stage you are at. I'll explain about emergency planning, emergency fund planning in the next slide. And then there is vacation planning. Some people are interested in starting their own jobs. They're interested in quitting their 9 to 5 corporate jobs, starting their own businesses. And for that, you should also end up doing a startup planning right from the beginning. So we talked about emergency fund. This is something that you should not be forgetting. Let's talk about how should you be planning for your emergencies and what is the appropriate amount over there. Your ideal accumulation in an emergency fund should be equivalent to 6 months of your expenses. So if your household expenses are 50,000 rupees per month, you should be planning 3 lakh rupees in an emergency fund. How should you be planning it? It needs to be in the form of a liquid fund, something that you can access very, very easily. Make sure that it is not in exposed to the equity markets. Make sure it is not volatile in nature, and make sure that you can dip into it, utilize it at a very short notice. A good alternative for emergency fund these days, although I've personally seen people utilizing bank accounts, fixed deposits for emergency fund, I'm going to give you a good alternative for emergency fund, and that is a debt mutual fund. We'll talk more in detail about what debt mutual funds are, but please do note that debt mutual funds are not investing in the equity market. They're investing in fixed income instruments such as bonds. They offer you complete liquidity, which means you can dip into them today. You can put in the redemption request today, and you can have the redemption proceeds in your bank account immediately as well. They are also able to give you better inflation adjusted results. So inflation exists at 7.5%. Inflation is that factor which eats into your savings. So inflation is at 7.5%. If you are investing in any instrument like a bank deposit or a fixed deposit at a 2.5% or a 7%, you are earning negative growth below the inflation. You're getting a net negative growth. So very, very important for you to invest in an instrument which is above 7%, which is above inflation. So a good alternative for those are debt mutual funds, which are able to almost offer you 9% annualized return as per the current situation. We were talking about goal planning. So this is how your goal planning exercise sheet should look like. You should do this for yourself. If you're not able to do this by yourself, you should take the help of a financial advisor. They'll clarify your goal planning approach for you. You should have all of your goals listed down. So for one client, we've done retirement planning, the children's education planning, the children's marriage planning, and we've also done a car planning. In the next column, we have jotted down the current expenses. Very important for you to identify what is the cost of that goal in current terms. For example, the retirement expenses per month at the moment are 2 lakh rupees. Also account these expenses for inflation. Remember the fact that when that goal happens, the expense will not be the same as today. The expense is going to get inflated by that many years. So after 16 years, we have inflated the expense to a 6.5 lakh rupees figure. All of these expenses are inflated. The time to achieve all of these goals have also been put in. And then finally, we have also included the priority of all of these goals. This means that you have complete clarity in your mind. What is the amount that you need for each and every financial goal? And whenever you get a surplus, you can put it in the relevant goal where there is the maximum deficit and which has the priority number one. So this gets us to our next interactive round. I'm going to do a live financial goal planning exercise for any one of you. I'll request any of the participants watching this webinar in order to volunteer for this exercise. No personal questions will be asked. This is going to have basic questions like what is your age, which goal do you want to plan for, and I will help you plan for that goal. I'll tell you what is the appropriate approach that you need to adopt for taking up this goal, for fulfilling that goal in the future. So can we have any participants who are willing to respond for this exercise? Any participants, please do put in yes in the chat box and we'll take up your goal planning exercise. Asmita says yes. Thank you for responding, Asmita. So Asmita, I'm going to, which goal would you want to plan for? Asmita, what is the financial goal that you would like to plan for? Wedding. Excellent. So I'm just going to open my screen and help you plan for your wedding. All right. What's your age, Asmita? $27. Thank you, Asmita. And what is the age at which you would like to get married? Well, congratulations. You're planning to get married next year. So if you could tell me, what are the expenses that you are envisaging in the current terms for your marriage? All right. Thank you. So I'm going to take into factor the inflation figure of 7.5 lakh rupees. Asmita, since we have only a year's time in order to plan for our marriage, we will have to go very, very conservative. Remember, I told you about short-term goals. So this is going to be a short-term goal, which is less than 3 years, rather less than 1 year in tenure. So the return expectation that we can have from an instrument which is conservative in nature and in today's terms is 9%. On hitting calculate, we are able to see your marriage planning. So when you get married next year, the 15 lakh rupees of an expense will inflate to 16 lakh 15,000 rupees. If you have to plan for this right now from today itself, there are two options. Either we start investing 1.28 lakh rupees every month in an instrument which is giving us 9% per annum, or we can put in 14 lakh 80,000 rupees in a lump sum in an instrument which is giving us 9% annualized returns. Since we have to go highly conservative, we have to ensure that our capital remains protected in the next 1 year. We will have to opt for debt mutual funds. And if you are interested in knowing about the detailed financial planning, what should be the various financial instruments within debt funds that you should be choosing, our team can reach out to you and do your financial planning through the registration details that you would have shared. Post this webinar, the team can reach out to you and work upon your marriage planning and give you a detailed investment plan in order to fulfill your marriage goal. Thank you very much, Smita, for volunteering for this exercise. All right. So remember, we talked about inflation hitting your savings as well as expenses. So this is what inflation does to your savings. Inflation is at 7.5%, which is reducing the power of your investments, and at the same time, it is inflating your expenses. So this is what typically happens if you leave your hard-earned money into your bank account or into fixed deposits, which are at 7% at the moment. See, look, if 1 lakh rupees is something that you have left in your bank account and you think at least it is going to remain protected over there, it is not really remaining protected. It is being hit by inflation at 7.5%, and the return that you're getting on your bank account is only 2.5%. So the net return that you get in a bank account is only -5%. Your investments are degrowing by -5%. So after 5 years, you'll realize that the savings have actually eroded to 7,73,000 rupees. I'm sorry, 77,378 rupees. After 15 years, the investment in the bank account has eroded to 46,000 rupees, and after 20 years, it has eroded to only 35,000 rupees. So 1 lakh rupees which you had left in your bank account 20 years back is only 35,000 worth now. And the opposite is happening to your expenses. So 1 lakh rupees of an expense today, after 5 years, will become 1.28 lakh rupees. It will become 2 lakh rupees after 15 years, and it will become 2.7 lakh rupees after 20 years. So you will realize, if you're keeping your hard earned money in your bank account, that for 2.7 lakh rupees of a monthly expense, you have only 36,000 rupees to pay for. How are you going to manage? And that is why it is important to invest into instruments which are giving you inflation beating returns. Gets us to the second interactive round of the session. What are your smartest investment options that you consider? So I'll request all of you to go back to the interactive round using the URL www.menti.com, menti.com. Use the code 89626373, and you will be prompted by a question: what are the various smart investment classes as per you? You are required to choose as many options as possible which you think are smart in nature, and your answers will be displayed live on the screen. Let's go for it. Those who have not been able to enter, you can use the QR code as well, which is displayed live. I will also share the voting instructions, so that if somebody has not been able to log in, you can do so via the voting instructions. So voting URL has been displayed live on the screen. Those who have not been able to enter can utilize this code and enter. Okay, we've started getting multiple answers. We'll just wait for another 1 minute for all of the participants to respond. A lot of participants have not responded. Audience, let's complete the poll. So far we can see 22% of the audience has responded that mutual funds are the smartest asset class. The next best answer is stocks and debt mutual funds. Very, very smart audience. And after that, we can see real estate. 11% of the audience feels that real estate is also an excellent asset class. And 11% of the audience feels that gold is an asset class. None from the audience feels that ULIP is a good investment class. So let's actually quantify the returns for all of these asset classes and figure out whether these are smart asset classes or not. So these are the asset returns that various asset classes have given over the past 1 decade. This is known as an asset return quilt. So if you look at year 2022, you can see that gold has been the best performing asset class with 11% returns. Credit risk, or these are debt mutual funds, have given us 5.5%, which was the second best asset class. Large cap mutual funds have given a 2.7% return, which was the third best asset class. Another form of debt mutual funds, which is corporate bonds, have given a 2.7% annualized return, and so on and so forth. Now, let's look at the top performing asset class over the year. In 2013, international or global equity gave the maximum returns. In 2014, small cap, another form of equity, gave the maximum returns. In 2015, debt mutual funds or credit risk gave the maximum returns. 2016, GSEC, which is government securities, or again debt mutual funds or bonds, gave the maximum returns. 2017, small cap mutual funds gave the maximum return. 2018, gold gave the maximum return. 2019, global equity once again. 2020, small caps again. 2021, small caps again, and 2022, gold. So you can see 1, 2, 3, 4, 5, 6, 7, 8 out of 10 years. Mutual funds have given the best possible returns in the history in the past 1 decade. And out of these 8 years, 1, 2, 3, 4, 5 out of 10 years, equity has given the maximum possible returns. Remaining 1, 2 out of 10 years, debt mutual funds have given the maximum returns, and another 2 out of 10 years, gold has given the maximum returns. So we can unanimously agree from this asset allocation quilt that equity in the form of various asset classes such as global equity or small caps, they have given the maximum possible returns, and equity, both equity as well as mutual funds, have become the best possible assets or the smartest asset classes over the 10 years. Now, depending upon your acumen, if you are not very well versed with the equity market, you should be starting with equity mutual funds. As and when you get to understand the equity markets more in detail, you become comfortable with the volatility offered, you can move on to direct stocks as well. So these are what the absolute numbers look like in the past 10 years. We've chosen the oldest mutual fund. The oldest mutual fund, which is Franklin India Blue Chip Fund, has offered a 19%, whooping 19% annualized returns in 15 years. Nifty, which is a benchmark of the stocks, top 100 stocks as per the market capitalization, has offered an 18% annualized return. Fixed deposits, a measly 7%, not so as smart. Gold has offered a 9% annualized returns over 15 years. We talked about debt as an alternative to emergency fund. Let's look at what debt is. Where does it actually invest? So debt mutual funds are instruments which are going to give you capital protection. They are going to protect your money no matter what is happening outside in the world, whether there is COVID, whether there is a Ukraine-Russia war crisis. Debt mutual funds are going to ensure that your capital remains protected. At the same time, in today's terms, they are able to offer you better than fixed deposit and better than inflation adjusted returns. So debt mutual funds invest in bonds, they invest in commercial papers, which are instruments, which are bonds, which are launched and issued by various large corporates. They invest in certificate of deposits, which are basically instruments issued by banks. They invest in treasury bills, which are invested instruments issued by RBI. They invest in other government securities and corporate bonds. All of these instruments. So remember that a debt mutual fund is going to diversify your investments across as many as 100 different bonds and securities. And all of these bonds and securities will give you a fixed annualized return. So, in effect, a debt mutual fund is more or less able to offer you a fixed return. That is the beauty about the debt market, and that is how it is able to give you capital protection. Here we have quantified a fixed deposit versus a debt mutual fund for you. How much money are you able to get in a fixed deposit versus how much money are you able to get in a debt mutual fund? If you have invested 1 lakh rupees in fixed deposits and in debt mutual fund, in fixed deposits, you will get 7% annualized return. In debt mutual funds, you will be getting a 9% annualized return. And if you keep this money invested for 3 years, here is what the differential looks like. Your post tax return. Remember, you'll also be taxed at your tax bracket. And if I'm assuming that your tax bracket is at 30%, then your 1 lakh rupees of a fixed deposit will give you a net return of 4.9% post taxation. The return is going to be 1,15,000, and a debt mutual fund at a 9% annualized interest rate is going to give you a 6.3% post tax return, and the post tax return is going to be 1.2 lakh rupees. So you can see that there is a 5,000 rupees of a difference between the two options which have been offered, and the difference in the returns is actually 1.4%. So this is a huge uh, return difference which actually compounds over years. So the longer you are able to keep your money invested in debt mutual funds, the higher will be the difference that you will get as compared to fixed deposits. So debt mutual funds will always be a recommended choice for your emergency funds, for your short term goals, for your capital protection needs. For those who don't understand mutual funds in detail, I'm going to give you a brief summary as to how they operate. Investors like you and me, we come together, we pool in our money, and we hand this money to a fund manager. A fund manager is an expert who understands various markets. They understand the equity markets, the debt markets, the commodity markets, the global equity markets in detail. It is their bread and butter. It is their daily job to analyze these markets in detail, and that is how they are able to select the best possible securities which are suited to your investment objective. The money is invested in these securities, and finally, the securities are able to generate returns for you as per your investment objectives, and the returns are passed on back to the investor, and the cycle continues. So, for those who are still not very sure about how mutual funds work, who think that mutual funds only mean stock market, this slide is for you. So, mutual funds don't only mean stock market. We just discussed that mutual funds also invest in bonds, which give you guaranteed returns. For those of you who think that we should not be investing in mutual funds because they are risky, this video is for you.
This International Men's Day, perception badlo towards men and mutual funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Moving on to the next objective and parameter of mutual fund. Mutual funds, there are also mutual funds which offer complete liquidity. Mutual funds don't mean that you invest in lock-in products. Mutual funds can also mean that you are able to invest for 1 day, for 1 week, for 1 month, for 1 year, whatever be the investment tenure that is there in your mind, there is a specific mutual fund designed for you. So mutual funds can offer complete liquidity. That means you can enter into the mutual fund market and you can exit into the from the mutual fund market whenever you want. So this video is for you.
लाइन लंबी थी क्या?
हाँ, लाइन तो थी, पर मैंने अपना सारा पैसा बैंक में डाल दिया। अब मेरा पैसा भी आराम करेगा और मैं भी। सही है ना?
यार तू आराम करे, सही है। फिर पैसे को तो काम पे लगा,
मतलब?
म्यूचुअल फंड में डाल।
अरे नहीं है, 4 साल तक कौन रुकेगा?
भाई ऐसे भी म्यूचुअल फंड्स होते हैं जिसमें तू 4 महीने, 4 हफ्ते, अरे 4 दिन के लिए भी पैसे रख सकता है।
क्या बात कर रहे हैं? सही है।
सीट बेल्ट पहन ले।
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन।
Next, mutual funds offer professional management. So if you do not fully understand the equity and debt market, it is best advisable, don't buy individual instruments yourself. Instead, enter into a mutual fund where there is a fund manager who can manage your money better than you by understanding all of the markets. Mutual funds offer diversification. That means that mutual funds invest into multiple securities, as many as 120 securities in one single go. And this follows the Warren Buffett principle of not putting all of your eggs in one basket. Mutual funds offer you tax efficiency. If you are interested in saving taxes for yourself, then ELSs or equity linked saving schemes are a good investment option where you can save as much as 45,000 rupees in taxes every year. Mutual funds are a regulated asset class. Just the way banks are regulated by Reserve Bank of India in India, mutual funds are regulated by SEBI or Security Exchange Board of India, which ensures safety and regulation for your hard-earned money. Mutual funds offer convenient options of entry. You don't need 10 lakh rupees or a large lump sum to invest into the equity market. Even if you have 500 rupees of a surplus every single month, you can invest into a mutual fund through an SIP. If you have a large amount of money at your disposal, you can always enter through a lump sum method. This video is for you.
सुना है you are selling your scooter.
Yeah, got a new car.
सही है. Big bonus. Promotion. तो
Savings.
सेविंग तो मैं भी करती हूँ, उसे कार नहीं आती.
वो एक्चुअली मैं काफी सालों से हर महीने म्यूचुअल फंड्स में थोड़ा थोड़ा सेव कर रही हूँ.
म्यूचुअल फंड्स.
कुछ फंड्स बेच दिए, bought a new car.
सही है.
The second part of our financial investment planning should be risk profiling. Remember, the first part that we talked about was goal planning. So secondly, we need to understand what our risk profile is. If your risk profile is conservative in nature, then you need to go for capital protection instruments such as fixed deposits, such as debt mutual funds. The recommended investment option is fixed income, such as debt mutual funds, and investment tenure will typically be between 1 to 3 years. If you have a moderate risk profile, if you are willing to take just a little bit of risk in order to ensure that you get a high reward component as well, then you should be investing in a mix of equity and debt mutual funds. This can be hybrid mutual funds, or you can be taking up individual equity as well as individual bonds. Your investment tenure needs to be greater than 3 years over here. And finally, if you have an aggressive risk profile, if you know that you're willing to take a high degree of risk with your investments, provided that you will be rewarded with high returns as well, then your recommended investment option is equity, both direct stocks as well as direct mutual funds, and your investment tenure should be more than 5 years. The third part that we talked about was asset allocation. Remember, go back to that Indian platter. So the first component in your portfolio should be Indian equity. A lot of people are hesitant about investing in the equity market because equity market goes up and down. Equity market is volatile. So I want to show you the journey of Sensex from 1980 till 2022. If there is one analysis that I can create out of this chart, it is चाहे इंसान हो चाहे equity markets हो, जाना दोनों ने आखिर ऊपर ही है. So in spite of all of the events that have happened in the history of markets, we can see the COVID, we can see GST, demonetization, Harshad Mehta scam in the beginning, for those of you who were born at that time, the 2008 financial crisis, the dot-com bubble collapse in 2000, the US-China war in 2016, or Fed tapering crisis in 2021, or even the Ukraine-Russia war lately in 2022. In spite of these events, so it is true that these events tend to dampen the equity markets for just a little bit, but the equity market is bouncy in nature. It rebounds. It rebounds after every single event, and in the long term, it only goes up. So if your financial goals are long term in nature, then equity market, you should be investing in equity market in order to get the best returns out of your portfolio. And for those people who feel that major events tend to hurt our returns, this is what the major returns have been after these major events. So 2020, most of you would remember COVID hitting the equity markets. So during 2020, the Indian Sensex had corrected by 37% in only 2 months, but immediately within just 11 months, the Sensex had also recovered by 100%. Now you can see that the recovery was actually much better than the correction that had happened. A similar event was in 2008 when the globe was hurt by the global financial crisis. Sensex had corrected by 61% in a year, and over the next 1 year, it had recovered by 157%. So true, Sensex or equity markets are corrected by various events, but they tend to recover back very, very fast, typically in the next 1 year or so. So the 10-year returns, which the Indian equity markets have shown, Sensex has given us a return of 13% annualized. Mid caps have given a return of 15% annualized. Small caps have given a return of 15%. IPOs have given a return of 21%. So if you have long term for your financial goals, equity markets are the best bet for you. You should be investing into the equity markets. Debt markets are best for your capital protection goals. Debt markets are best for your goals which are short term in nature. Debt mutual funds in the current time are able to offer you a 9% annualized return. They are able to give you a return better than fixed deposit, better than bank accounts, and post taxation they are able to give you a 6.3% annualized return, much better than the 4.9% that you will be getting in a fixed deposit. Thirdly, there is global equity. So within global equity, you should be investing for three purposes. One, you should be investing into global stocks or global mutual funds, because they give you, sitting in India, they give you the exposure to multiple global stocks like Microsoft, Tesla, Uber, Booking.com, Synapsys, Advanced Synaptic Devices, sitting Amazon as well. Sitting in India, you can invest in all of these good quality stocks. So while you and I tend to use all of these companies, we use Amazon for our shopping, we use Uber for our travel requirements, we use Microsoft for our meeting requirements, virtual meeting requirements. Why should we not be owning these companies? It is very much possible for you to sit in India and own a percentage of these companies and enjoy their growth through investing in global equity, global stocks, or global mutual funds. uh, they also offer you the effect of INR depreciation. So if INR has been depreciating by 5% against US dollar every year, by investing in global mutual funds, you will get the positive impact of this INR depreciation, because you are investing in US dollars. So if your global investments are actually giving you a 15% annualized return, the 5% INR depreciation will get added to it, and the net return that you will be getting is 20%. So over the past 10 years, global S&P 100 index has offered a 10% annualized return. Nasdaq Composite has indeed offered a 14% annualized return. So excellent returns, and they are also able to offer you geopolitical diversification and good exposure to good quality international stocks too. So yes, these three factors we've already talked about. Invest into global equity for exposure to global stocks, benefiting from INR depreciation. Another reason, geopolitical diversification. Imagine a scenario where Pakistan declares a war on India, or India is having a trade war scenario with China. So these are again local events which will offer the Indian equity markets. But if you are holding 10% into a global equity portfolio, that 10% global equity portfolio will remain insulated to all of these national geopolitical shocks. Offering you some pro tips for asset allocation. Always follow a dynamic active asset allocation model. It means that after investing about 80% into equity and 20% into debt, do not go to sleep. Monitor your finances every year, and as per the market conditions, continue to shift between debt and equity and enjoy superior returns. Your financial advisor can help you with your active asset management. Secondly, you should also leave some liquidity for market corrections. This is what we do for every single investor who invests with us. We ensure that about 10% of the investments are kept into debt markets, and whenever the market corrects, we invest this 10% into equity markets, and we make the investor enjoy the recovery whenever that happens after the market has corrected. So this is one example. When the market had corrected by 37% in 2020 during COVID, we invested into the equity market, and we got 100% absolute return whenever the market recovered in less than 1 year. There is a mantra, a beautiful mantra for making returns in a volatile market. People who feel that equity markets give negative return, this is a good option for you to get superior returns out of your portfolio. And this is characterized by 3 C's. These 3 C's are cash, courage, as well as crisis. So one, you should be having cash in your hand. By cash, I mean you should be holding liquidity in your hands, which is not in the equity markets, and this you should be utilizing to invest into the equity markets whenever there is a correction. Second, you should have the courage. So whenever stocks or equity markets are giving you negative returns, even your portfolio is in red, when the newspapers are making headlines that the equity markets are correcting, that is the time when you need to have courage in order to invest into the equity market. And thirdly, you need a crisis event. Now this crisis event does not come very often, but whenever it comes to you in the form, consider it as an opportunity to get superior returns. Whenever there's an event like a correction, a trade war correction, a political war correction, or any geopolitical event which is shaking the equity markets, at that time consider it as a crisis, and at that time have the cash and courage to enter into the equity markets, and you will be indeed rewarded with superior returns over the long term. Another beautiful story, a question to all of you. Please listen to this story carefully. There's going to be a question at the end of it. Uh, when should you be entering into mutual funds? So here there are two investors, A and B. Both are 30 years at the moment and they want to invest into the equity markets for their retirement. Both have 1 lakh rupees to invest every year and they start investing. So A is a diligent investor. He starts investing at the age of 30. So every year he invests 1 lakh rupees into the market and he gets a 10% annualized return out of that market. So at the end of 30 years, he has invested 30 lakh rupees into the markets. The second person, he's a more casual investor. He feels that he should be going out to restaurants and cafes with friends every single week. He should be watching movies every single week. He should be going on to global trips every single year. And what is the hurry? So for 10 years, he wants to enjoy his life and earnings. And at the age of 40, he starts investing. So from the age of 40 to 60, he starts investing and he invests 1 lakh rupees every year, again in the same instrument as A, which is giving him 10% per annum. The difference in A and B is that A has started to invest at the age of 30 and B has started to invest at the age of 40. These are the statistics. Please go through the statistics carefully and I want you to give me an educated guess. Please, no calculations, but give me an educated guess as to, at the age of 60, when both of them retire, what is the corpus available to both of them? So you can see that A has invested 30 lakh rupees because he started at the age of 30, ended at 60 at 10% per annum, and B has invested 20 lakh rupees. He started at 40, ended at 60 at the rate of 10% per annum. My question to all of you is, what do you think is the final deal clincher? What do you think is the final corpus that is available to them at the time of their retirement? I look forward to your answers coming in. All right, I'll just repeat the statistics once again. So A has invested 30 lakh rupees from the age of 30 to 60, and B has invested 20 lakh rupees from the age of 40 to 60. What do you think is the final corpus that would be available to them when they retire at the age of 60? Remember, they were investing at 10% per annum. What do you think is the final corpus available to A and B? And I look forward to your answers coming in. We'll wait for the next 1 minute. Participants, it's a simple question, no calculations. Just give me a guess. What do you think A and B will accumulate when they retire at 60? Why are we not getting any answers? It's a very, very simple question. A has invested 30 lakh rupees at 10% per annum. B has invested 20 lakh rupees at the rate of 10% per annum. What do you think will be the corpus available to them at the age of 60? All right. So Prashasti says around 1 crore will be available to whom? A or B? I want to understand what is the final corpus available to both A and B as per you. Any guesses? Participants, do give me your guesses. What do you think A and B would have accumulated at the age of 60? No need for calculations. It's okay. Don't worry about the fact that it's going to be a stupid answers. I'm looking forward to your answers. Prashasti says A has accumulated 1 crore rupees. What about B, Prashasti, and any other guesses from anybody else? Asmita says around 50 lakhs for B. So both of you are very, very close to the answer. Let's figure out. One says Manan is going to get 1 crore and the other one is going to get about 60, 70. Asmita says around 2.5 crores for A. Shivangi says 70 lakhs for A. Let's figure out the right answers, shall we? All right, so here are the right answers. A has accumulated 1.8 crore rupees above anybody's guess over here, and B is stuck at 63 lakh rupees. So the difference in the investment amount was only 10 lakh rupees, but the difference in the final corpus is 1.2 crore rupees. Staggering, isn't it? And this is the advantage of starting early. A got that advantage by starting 10 years early. A final slide, final video for all of you as to why working with a financial planner tends to give people a superior advantage as compared to those people who invest on their own. And this is one video for you.
I know Ingenitus team since 2012. It's almost 10 years. Over these 10 years, I have found Ingenitus advice to be extremely helpful. Uh, we started our investments with a very small portfolio of mutual funds. I had a child around the same time, and I was worried how will I manage my financial goals, education for my children, retirement for myself. Ingenitus team helped me to chart out a plan that gave me a clear view of my investment needs today and the financial goals that I will need to achieve in the future. All in all, they have been able to take over my entire financial needs into one place and connect everything collectively to give me the right advice. I'm very happy to share. Today, I enjoy uh, a lot of freedom from stress because I'm secured with the corpus that we've been able to create with Ingenitus. Uh, I'm secured about my child's education. I'm secured about my health needs. I am secured about my financial planning around some key milestones. I want to buy a better car. I want to buy a house. And my corpus is helping me to do that. More importantly, I think today I'm able to make choices to live my life and work in a fashion that is of my choice rather than a compulsion on finances. And lastly, I am a banker. I have 20 years of experience, but that doesn't mean I'm an expert in investments. So always use an expert advice. Make sure you have the right people with right skill sets and right knowledge and right experience giving you financial advisory to make sure that your investments are generating the best returns as well as safeguarding the risks around your investments. Start early, start small or big, whatever you can, but make sure you make a start.
That brings us to the end of the session. You are more than welcome to note down our contact details. Those who are in need of financial plan planning, those who would like to associate with us, please feel free to reach out to us on our email ID mentioned on the screen or on our contact numbers. With that, we would like to move to the question and answer session. If there are any question and answers, wait for the next 1 minute, and we'd love to take over your questions. So IPO Info has actually put down a comment. Savings account interest rate is always inflation rate is always above inflation rate as per RBI. So here I would like to give you a correct fact. Inflation rate at the moment is at 7.5% per annum. If you look at the past 10 years of inflation figure, and if you look at the savings account interest rate, it is at 2.5%. Even if we look at the current figure, the CPI inflation figure has come out to at 4.7%. But if you look at the current savings account rate, it is only at 2.5%. So no, savings account interest rate has not been over inflation as per the RBI. This is an incorrect myth. Then the second factor that the same person is asked is mutual funds do give negative returns. It is true, mutual funds can give negative returns if they are not correctly invested in, or if you are looking at a very short term view. That is why it is extremely important to invest as per your financial goals and as per your risk appetite. If you cannot uh, absorb any sort of a negative return, it is best to go for capital protection instruments such as debt mutual funds, which are likely to give you positive returns even in a short duration of time. At the same time, if your financial goals are short term in nature, then you are advised to stay away from the equity market. You should instead be investing in debt mutual funds, which are likely to give you positive but inflation beating returns even in the short term. RT has asked us, consider that earlier investments are withdrawn and invested in property, etc. Now reinvested, restarted much later after 40 years. Does it mean it was a wrong decision to withdraw, redeem? So it's quite likely that you have withdrawn and invested in property and then restarted later after a total, I'm assuming after a total of 40 years. Does it mean it was a wrong decision to withdraw, redeem? I would not say that it was a wrong decision, because the decision is something that you would have made as per your understanding, as per the advice that you would have been given at that point of time. um, Please do understand that if you look at the annualized returns, we've seen the annualized returns in the equity market. The bare minimum returns that Sensex has offered over the past 10 years has been 12%. But I have not seen a single real estate investment in retail which has offered more than an 8% annualized return. So the return differential between a real estate and the equity markets is certainly going to be there. You would have lost out on that return differential within the period that you would have been invested into the real estate market. But now that you have started back once again, you have reinvested into the equity market, whatever time frame you have, 10 or 20 years till the time you require those financial instruments, this is the best time that you can actually make out of the equity market. You would have definitely gained something out of that real estate instrument. Even if you have not gained anything, consider it as a loss, but consider the next 10 years or 20 years that you have till the time you retire as an opportunity to make the best out of the equity markets, and an opportunity to cover upon the losses or cover upon the bad investment that you would have made in the past. All right, investors and participants, thank you very much for being such an interactive audience with us today. It was amazing to have you over here. Please do note that in today's session, we talked about only the basics of financial planning. The future webinars are going to be more specialized. They would be focusing upon aspects like tax planning, protection advisory, insurance planning, planning for your retirement, and planning for your investments. So we look forward to all of you being there in the future in our future webinars. The links will be forwarded to you. The invites will be forwarded to you very soon. Thank you very much for connecting with us today. Take care. Signing off. Bye-bye.